Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, founder and CEO of KKM Financial. Jeff, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill. Great to be here.
All right, you got it. And certainly a reversal of fortune that we've seen in the markets this week. It seems to be it's strictly focused on macro, never mind earnings.
Without a doubt. And you really feel this shortened holiday week, only 4 trading days, but it's been tough sledding. And actually, if you look and take a step back, Jill, we've talked about this a lot on your show, is we're in a trading range. And the trading range, the only optimism or positive takeaway is that trading range continues to move higher, meaning that we are having higher lows. So if you look at the S&P 500, this has been a very technical trade. We went down and almost kissed it today at 39.40. So we are exploring the lower end of the range as we see the 10-year note move higher, as we see the hawkish fears. And today, the favored metric of inflation, PCE, we saw it come in hotter than expected. And I think the one solace I take is that this is something that we really have to understand as investors and traders. Investors and traders understand that it's not a linear line. When we saw the Fed trying to move inflation above their 2% target for years and years and years, it happens in ebbs and starts and fits and stops and all the different movements that we typically have to get this movement. So right now, I don't think there's a panic button. I think it's actually a great buying opportunity, but you have to trust the technicals when you see the emotion and when you see interest rates move the way they have.
Right. It seems as if the equity market and the bond market are reading the Fed's messages in two very different ways. The equity market wants to do one thing, and it seems to be that the bond market is processing what the Fed is saying.
And it's almost like there's a lag effect to amplify your message. I agree with you. I look at the bond leadership. The bond market was convinced that the Fed was going to pause, and the Fed may still have the ability to pause if they do see the inflationary data really abate the way we anticipated to. But right now, this one reading in January is really kind of throwing the markets off, and the 10-year note went back up to 4%. So that type of velocity in the bond market, of course, is going to dampen the enthusiasm, which we saw in equities in January.
Right. And the movements that we've seen in bonds, they typically don't move that fast historically. And it seems as if the equity market is really struggling to keep up with that.
It is and it isn't. I mean, if you think about the rate normalization process, a historic rate normalization process we've never seen before, when the 10-year note went from 1.4, 1.5% to nearly 4.5%. That was 2022. We don't like to say the words 2022 anymore because it's in the rearview mirror, but we're still seeing a ripple effect. So I take solace in the fact that the market is moving higher. Earnings, we don't even talk about earnings, right? But they have been better than expected. And the consumer, today was an interesting metric. The consumer came out stronger than since March of 2021. So the data is showing that the consumer-driven economy is not anywhere near a recession. So that's where the Fed has a bit of a conundrum, where if they try and push too hard or raise rates too hard, they are going to tilt us in a recession. I think they end up playing a game of chicken here with the market, and the market is saying, raise it one more time and take a big, deep breath, Fed.
Right. And longer term, you are still constructive. You've been saying so since the end of 2022. Actually,
I've been cautiously optimistic. And yes, I think this 39.50 level, 39.40 is the 200-day moving average in the S&P 500. I think it's a great opportunity to allocate if you're sitting in bonds and cash. I think you have to be really considerate of the way we're going to move higher this year after what we saw in 2022 is not going to be a straight line. So embrace this volatility. Don't run from it.
All right. Appreciate the insight as always, Jeff. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.